Between June 1998 and December 1999, one personal stock portfolio grew from exactly $10,775 into $18 million. Dan Zanger, a swimming pool contractor in Los Angeles, generated those returns using a single personal account. Zanger relied on a mechanical, robotic system, a strategy forged from the experience of losing everything he owned. In 1990, Zanger inherited $100,000. He traded that initial stake up to nearly $500,000 within 6 months of the market entering a powerful bull run. Confident in his success, he started mentally spending the profits, calculating which exotic sports cars he could afford, and imagining a completely new lifestyle. When the market corrected, his account began a 6-year bleed-out. He stubbornly held on to declining stocks, refusing to cut his losses until his capital was nearly exhausted. The October 1997 market break delivered the final blow. Zanger was heavily leveraged with borrowed money, and the volatility was so extreme he could not even reach his broker to sell. The crash wiped him out completely. He ended the day owing his broker a $225 margin debt. To clear the debt, he sold his 1984 Porsche for exactly $11,000. The sale left him with $10,775 to his name. Rock bottom destroyed his ego. He stripped all hope and belief out of his trades, deciding that rules would replace his intuition. Zanger returned to the market during the dot-com bubble with an emotionless focus on strict risk management. He monitored the market from the cab of his Toyota pickup truck, driving between pool construction sites in affluent neighborhoods. His primary tool was a bulky cellular phone used to call in orders and a crude FM radio receiver on his dashboard, scanning for surges in trading volume. Being physically detached from a trading desk forced him to ignore market noise and rely entirely on alert-driven mechanical execution. His filter was simple. He ignored cheap stocks to target expensive companies displaying explosive growth, with quarterly earnings ramping up 50 to 100%. He sought out specific geometric patterns, like the horizontal channel, a period where a stock price consolidates between a clear upper ceiling and a lower floor. Zanger waited for the exact moment the price action punched through that ceiling. He only committed to the trade if he saw a sudden spike in volume, often 300% above the average. Volume is the only reliable footprint of institutional money. Without it, a chart pattern is just a trap. Zanger treated exits with the same cold precision as his entries. If a stock broke down from its pattern, he sold it immediately. He used a 21-day moving average line to track the momentum of his winning positions. The rule was absolute. If a stock price closed below that average, he sold 50 to 100% of the position. During the dot-com bubble, he frequently sold his winners within 3 to 5 days, exiting the moment the price momentum showed signs of stalling. This mechanical exit rule acted as his armor, preventing a repeat of the catastrophic, ego-driven losses from 1997. Repetition of this mechanical process turned his $11,000 car sale into $18 million by December 1999. These returns underwent professional accounting audits, checking his tax returns and trade tickets to verify his performance as a legitimate world record. Despite making millions of dollars in a single day, Zanger maintained a frugal, emotionless detachment from the money. He viewed the market as a psychological machine designed to strip wealth from those driven by hope or fear. Zanger's record proved that protecting capital on the way down is as critical as picking winners on the way up. It requires an egoless discipline to believe in stops over stocks.